Good morning, good afternoon, and good evening. Today, we'll be going through a topic in income tax, employer benefits in kind. Last time I took you through income tax computation without including these items. That will serve as a basis for the computational aspect of this particular topic. And the theoretical part, I'll be taking you through as well, briefly today. As usual, I would like to remind us of the type of taxes we may be encountering. For instance, the income tax which we did last time, and corporation tax we'll be looking at, capital gains tax, and so on, and the legislation that gave birth to them, and those who suffer this particular type of taxes. Again, I always like to show my students the computational pro forma, the income tax computation pro forma. This helps us to allocate the incomes into their group, because different incomes have different reliefs relating to them, and again, it helps us to know how to compute our tax beneficially or allocate our personal allowance. We start from other income, then gradually to savings and dividends. Again, I'd like to briefly show you the income tax table or tax tables, as the case may be. For instance, the 2023-24 tax year, this is the table here showing the band, the income tax, taxable income, and the rates. Now, the benefit in kind, employers' benefit in kind, we call it BIK, which is the topic of today. These are non-cash perks and fringe benefits provided to employees by their employer. They have monetary value, though they are not physically paid in cash to the employees. They are items not wholly, exclusively, and necessary for the purpose of business. So any item that has some personal benefit in it are termed benefit in kind and attract taxable values. Having said that, the taxable value itself will be tax on employee, and the value will attract what we call the Class 1A national insurance at the rate of 15%. These items, as I said, are benefit in kind, and you might need to pay tax on the value of these benefits. Some of the benefits are always taxable. For example, goods that your employer lets you have for free or below the cost value or price. The taxability depends on whether they exceed certain limits. For instance, seasonal tickets loan are taxable if the value of all employer loan, is more than 10,000 for the year. Now, typical example of BIK as follows. We have what we call the company car and fuel benefits. We have private medical insurance, which employer might give to employee annually. We have private medical insurance. This is calculated based on the annual cost to the employer to provide this coverage. We have interest-free loan or low-interest loans. We have living accommodation allowance, asset provided for personal use. For company-owned asset, the taxable value is the greater of 20% of market value, or the actual rental paid by the employer. Let's look at car benefit closely. As I said, you pay tax on the car itself, and where the employer provides you with what we call the fuel for the vehicle, you'll be taxed based on a multiplier which is annually provided by the Inland Revenue. This multiplier for the tax year 25-26 is 28,200. For 26-27, the multiplier is 29,200. So this is the multiplier. Okay. But the taxability or the tax value of these particular items are based again on the CO2 emission of the vehicle itself. Here is an example below here. If you drive a petrol car with a benefit in kind rate that is CO2 of 25%, for the tax year 25-26, which is 28,200, your taxable value will be 7,050. That is 28,200 times 25%. Now, the physical tax itself will depend on your category, and whether you are basic rate payer, higher rate payer, or additional higher rate payer. For basic tax rate payer, it will be straight 7,050, okay, which is value times 20%. For higher rate taxpayer, it will be 7,050 times 40%, and so on, depending on your band you fall into. As a note for all employees, it is very important that you look at the real value to you, the enjoyment you derive from this particular benefit or BIK. If the real benefit to you in terms of maybe your enjoyment is not, because money is not maintained in life, you must think of your enjoyment, the value you gain from that particular benefit. If you are given a car, very high CO2 emission rate, you will be paying more in tax. It is not good if you have personal car or any other, if you have another alternative car which is less expensive to run, it's better stick with your personal car. Again, accommodation. If you are given accommodation where you have it difficult to meet friends and family, maybe very far away, which may entail you to have another house very close to your friends and family, it's no point taking all that accommodation because you are not deriving the real enjoyment. It's not here, because life is not all about money. It's about your personal enjoyment in life, the quality, the quality of life you enjoy using that particular benefit. So be careful when you accepting this employer benefits in kind. Having said, there are steps you need to kind of follow to arrive at this the taxable value. So the first step is to determine the cash equivalent of that particular benefit. As I've already mentioned about car, you have to get the cash equivalent. The car itself, I have to remind us here, is based on the market price, okay, of the car. If the price list is 30,000, the value, and then based on the CO2 emission of that particular car, the value will be the market price list, say 30,000 times the CO2 rate. That's the value of the car benefit. You have to get that down. If petrol again is provided and paid fully for the year by your employer, the value again will depend on the multiplier value specified by the Inland Revenue in that particular year. So if it is, as I said, 28,200 for the year 25-26, then it will be 28,200 times the CO2 rate. Once you get this value, that's step one. The step two is for you to see your personal contribution any amount you made good for that particular benefit. If you deduct that from the total benefit, the balance is the benefit that is taxable on you. Where, for argument's sake, for petrol, it is an all or nothing refund. It's an all or nothing repayment. So if the value to you is kind of 7,000 and you made good just 3,000, you will still be taxed on the full value based on the petrol multiplier. You either pay the whole value back or the whole petrol provided to you by the employer during the year, or bear the consequences of the rateable value for the petrol. So that is the step 3, the taxable value. You get all the taxable value down. It's on the taxable value that you now pay the tax on, depending on your status. If you are a 20% class taxpayer, you pay tax at 20%. If you exceed that, going to 40%, you pay the 40% on the excess value. And if you are 45% taxpayer, you pay 45% on the excess of that particular value. The employer, as I said, will need to pay what we call the Class 1A National Insurance Contribution. This is straight 15% on the total taxable benefit value. Having said, there are what we call tax-exempt benefits. Tax-exempt benefits are, for instance, mobile phone per employee, primarily for business use, the workplace car parking or cycling to work scheme, entertainment, staff entertainment, and the annual party. For instance, we go to Christmas party by the institution, but it's limited to 150 per head. So if you are an employee, your employer can spend up to 150 pounds on you during Christmas party. Make sure you drink as much as you can. All right. Free or subsidized canteen meal provided to all employees, on site, not at home. It must be on site, your work premises. A certain employer pension contribution within designated allowance. These are tax-exempt benefits. Now, having said this, let's look at a scenario using the information on the screen here. Let's use that information on the screen here. This is scenario 1, tax year 25-26, gross salary 50,000, bonus 5,000, employer provided car, list price is 30,000, CO2 emission is 25%, fuel again is provided for private use. Also, there is medical insurance paid for by the employer. Employee, you paid pension contribution of 3,000 gross. Your personal allowance for that particular year is 12,570. Looking at the gross, we assume here that this gross pension contribution is deducted from your gross salary before you pay tax, before tax is calculated. The reason for this is when it's paid out of our net take-home pay, we need to extend our bands. These bands here will be extended by the gross amount of the contribution, pension contribution. So if it was paid out of your pocket before, from your net pay, you have to add 3,000 to this, 3,000 to this, and to the next band 3,000. In this case, it is deducted from our gross pay. Okay. So now let's slot in the items line by line into the pro forma, which I've actually explained to you earlier. So the salary with less pension from gross salary, so it is 47,000. 50 less 3,000, 47,000. Put it under orders and extend to the total column. The bonus again is 5,000. Extend it to total column. The car benefit, as I said, is the price list is 30,000. So it's 30,000 times the CO2 emission 25% give us 7,500, which extend again to total column. The fuel provided by the employer for the year, the multiplier amount is 28,200 for that particular year, times 25%, that gives us 7,050 for benefit value. Put it in this section here. Extend it to total column. The medical insurance is 1,500, put it under order again as a benefit, and then extend to total. If you notice, I have actually provided another column in addition to what I showed you last time. I provided a total column for total benefit column. We extend all the benefit to this column. So the total benefit is 16,050. So the employer will pay the class 1A and I 50% on that, straight 2,408. That is the class 1A and I. Now, let's now come back to the tax computation for the employee. The total income is 68 and 50. It is below the 100,000 threshold, so there is no need to adjust the personal allowance. So it remains 12,570. Total taxable income, therefore, is 68,050 less 12,570 to give us 55,480. This is the taxable amount. But I try to assist my students, to have a check on their value taxed. So the total tax, the total income here should be 68 and 50 equal to total income here. So the first band to be taxed is 0 to 12,570. The value is 12,570 here. This minus 0 is that. The rate is 0%, so the tax is nothing. Now, from 12,570, which is there, to the 20% band rate, band, which is 5270, the difference is 37,700. That's the value between this and this. Our 20% rate, the tax is 7,540. Now, from the lower 20% band, which is here now, to the 40% band, but remember, this is quite below the 40% band, because the total income is not up to the band for the 40%. So that's the total income here. So bring that here straight away. So 68 and 50 less 50 and 270 gives us 17,780 value to be taxed at 40%, and that gives us 7,112 tax. So if you add up all this value, you will see it agrees to your total income, though the personal allowance value is not taxed. But why I put this is to check to make sure you are doing well. I'm happy. All my bands and the values have been correctly extended. Now the tax now is these two, 7,540 plus 7,112, 14,652. That's the tax liability for the employee. The class 1 A and I is 2,408, which I earlier said to you is the 15% on the total taxable benefit, which is 16,050. If you have followed this logically, go through this. It's very important that this area is very important, so you know the rate and the value you are tasking at those rates. Right. Next time, I'll be looking at NI. I'm looking at NI calculations. I'm trying to build on this particular tax gradually, because rushing them might give us problem. So if you are watching me for the first time, please subscribe to this channel and like this particular tutorial, because it's just the way to encourage us to keep releasing such topics. And then please try and share to your friends and family and others, colleagues who might be interested in taking tax as a career. Thank you for listening, and until I see you next time, goodbye.